All right, let's talk about the big one hitting the Hong Kong exchange, the Lemo Services IPO, ticker 2539. If you're on the fence about whether to subscribe, this is for you. We are going to break down absolutely everything you need to know to make a smart decision.
So here's the million-dollar question, right? You see these massage chairs everywhere, malls, airports, you name it. Are they a hidden gem, a fantastic investment opportunity hiding in plain sight? Or is this just a really risky bet? We're going to find out. Here's our game plan to get to the bottom of it. We'll start with the IPO itself, then decode their business model, how they actually make money. After that, we'll run a financial health check, unpack the risks, and cover the unique dynamics of the Hong Kong market. And then, at the end, I'll give you my final verdict and my personal strategy.
So, first things first, who exactly is Lemo Services? Well, they're a massive player in the public massage chair game. You've almost certainly seen their chairs in high-traffic spots all across China. Think shopping malls, movie theaters, train stations. They're everywhere.
But here's the key thing you have to understand. This isn't just about putting chairs in a mall. Lemo is, at its heart, a technology company. They use their own proprietary Internet of Things platform, that's IoT, to manage their entire sprawling network. That's their secret weapon for scaling up so effectively. Now, here's a term you absolutely need to know if you're investing in Hong Kong IPOs: cornerstone investor. Basically, think of these as the big, serious institutional players who agree to buy a huge chunk of the shares before anyone else. When a company like Lemo gets a cornerstone on board, it's a huge vote of confidence. The market really pays attention to that.
Okay, so we know who they are, but how does this all translate into a profitable business? Let's get into the nitty-gritty of how Lemo actually makes its money, and, just as important, how it plans to keep growing. It all comes down to a really clever, two-pronged approach. Their strategy is kind of the best of both worlds. It blends tight control with incredible speed. On one hand, they run some locations themselves. This lets them control the quality and the brand experience. But on the other hand, they team up with local partners. This is the asset-light approach that lets them expand into new areas super fast without needing a ton of cash up front. It's this dual-line model that's so powerful.
And you can see just how well that strategy has worked. I mean, look at where they are. They've totally dominated commercial complexes and cinemas. That's over 85% of their business right there. They aren't just throwing chairs out there randomly. They are surgically targeting places with guaranteed high-volume foot traffic. And the engine humming away behind all of this, it's their custom-built platform, LMB Links. You can think of this as the central nervous system for their entire operation. It lets them manage thousands of chairs remotely, schedule maintenance, and, critically, analyze all that juicy consumer data. It's what makes the whole thing work. Okay, so the business model sounds great on paper, but you know what they say? Talk is cheap. We need to see if the financial evidence actually supports the story. So let's pop the hood and see if the numbers really add up. And yep, the numbers absolutely back it up. Just take a look at their revenue growth over the last few years. That's not just a little bump. It's a clear, strong, consistent upward trend. This is the kind of hard evidence we look for to prove that an expansion strategy is actually working. And if you want to understand the sheer scale we're talking about, just look at this number. Over 174 million cumulative users. I mean, that's just a staggering figure. And it's not just a vanity metric. That represents a massive user base and an incredible treasure trove of transaction data they can use to get even smarter. All right, we've seen the bright side. It's an impressive picture, but any smart investor knows that's only half the story. You have to turn over the rocks and see what's hiding underneath. So it's time to dig into the prospectus and unpack the key risks you have to consider. So here they are, the top 5 risks I pulled right from their legal filings. You've got your usual suspects, losing their prime locations, partners becoming competitors, data breaches. But honestly, it was that last one, the non-compliance with regulations, that really jumped out at me. And when you dig into it, the prospectus is surprisingly frank. It openly admits to non-compliance incidents with things like employee social insurance. Now, in China's strict regulatory world, this is the kind of thing that can be a pretty serious red flag, potentially leading to fines or other penalties. However, and this is a really big however, context is everything. The company's legal advisors have gone on record confirming that this had no material adverse impact, and they've already set aside the money to cover any potential costs. So while it's definitely something you need to be aware of, it seems to be a manageable historical issue, not a deal breaker. Okay, now let's zoom out a bit, because investing in an IPO isn't just about analyzing the company in a vacuum. You also have to understand the specific market it's listing in, and the Hong Kong market has its own unique quirks and rules we need to talk about. One of the most important features is something called the green shoe option. It's a funny name, I know, but all it really means is that the bankers running the deal have the option to sell more shares if there's a ton of demand. Why should you care? Because it's a tool they use to help support and stabilize the stock price right after it starts trading. It's kind of like a safety net. So let's pull all of this together on a simple scorecard. On the strength side, you've got that clear dual-line model, fantastic tech, a huge network, and proven growth. On the weaknesses and risk side, we have the issues we just discussed. This gives us a really clear, balanced picture as we head into the final decision. And now, we're at the moment you've been waiting for. After sifting through all the evidence, weighing the pros against the cons, what's the final verdict? And maybe more importantly, what's the smartest way to actually play this IPO? My verdict on the Lemo services is a full 5 stars. For me, this is the priority target in this round of IPOs. The fundamentals are solid, the business model is a proven winner, and the risks, while they're definitely there, seem well managed and understood. So how do you actually subscribe? Well, it depends a little on your setup. If you're fortunate enough to have access to multiple brokerage accounts, the strategy is simple. Go broad. Spread your cash subscriptions across all of them for Lemo to get the best possible allocation. If you only have a few accounts, don't single bet. I'd suggest splitting your capital, say 70-30 or 60-40, heavily favoring Lemo but putting a little in a secondary option. This hedges your bets and helps ensure you get an application in. And for those of you thinking about using leverage, a few quick tips. The Group A maximum, that's the top end for retail investors, is probably a more efficient use of capital than the Group B minimum, which is for high net worth. But if you have the funds, a bigger subscription in Group B is definitely the power play. And as always, please do your own final checks. Make sure your cash flow is clear and you know your specific broker's rules on margin. And all of this brings us to the final, lingering question. Lemo Services has a fantastic, solid model, but it also comes with a clear set of known risks. So, will it be able to navigate those challenges and deliver the kind of post-IPO pop that investors are hoping for? Well, that's the question only time can answer.